All right, we had quite a few more people jump on, so we're going to get started here. Super exciting, though. I see a handful of familiar names, people that are we've either spoken with or are already actively investing with us. So that's great. We love to have our community continue to come back to the webinars. But I also see a lot of new names, so that's also exciting as well. We're looking to grow this community. So on a side note, if you have friends, family, colleagues that have interest in what we're talking about on these webinars, you can either let me know, I'll put my contact information up at the end of the webinar, and we can definitely add them to our email list so they get notified of our monthly webinars and other marketing things that we send out, and or you can just send them the link. So either way works for us, but like I said, we're always looking to grow this community. My name's Heather Dreves. I'm with Central Lending, and we're going to talk about what it really means to create passive income through private lending, and it's kind of timely. I actually had a phone call with a current client of ours yesterday, and we talked for over an hour about this. And there are some different options as far as how you can go about getting involved in private lending, and we're going to talk about that today. And there's definitely pros and cons to both. And so I tell investors and clients all the time that I'm talking to, whether they're currently invested with us or just looking to explore that option, it's your job as a responsible investor, and for as somebody that is taking control of deploying their capital outside of your traditional resources with financial advisors, that it's your obligation to do your homework and your push-ups. And so we pride ourselves on, this is not a big sales pitch for you guys. It's really just to educate you guys and give you the tools that you need to explore these different options. So we're going to get started here. Like I said, as we go along, I want you guys to feel free to definitely ask questions. I want this to be an interactive presentation, and so by all means, I encourage that. So really, what is private lending? I think there's a lot of information out there in the internet space, and there's webinars and podcasts, and I think sometimes people hear this buzzword and they don't really know exactly what it means to be a private lender or what private lending is in itself. So private lending really is very simple. It refers to the process where individuals or non-institutional investors provide loans directly, typically to real estate investors, sometimes developers, and sometimes they also make these loans to businesses. But we're going to talk more specifically today about being a private lender for real estate investors and builders per se. This is lending that's outside of your traditional bank options, and these are loans that are typically secured by tangible assets, most often real estate. And again, that's what we're going to specifically talk about today, is private lending in the real estate space, lending money to other real estate investors that are actively investing in real estate. Whoops, I went the wrong way. So key components of private lending, a lot of people say, well, what does it entail? Who does it involve? So I thought this was a pretty simple outline of really kind of the components of private lending. Typically, you have a borrower. This is usually a real estate investor or developer seeking short-term financing for fix and flip projects, sometimes new construction, or what we refer to as what is called a bridge loan. So these are short-term loans. So these loans that we provide these active real estate investors are not intended to give them 30-year loans to hold a rental property. These loans are intended to provide a borrower with the funding that they need to buy a property, and then also exit our loan in a very short period of time. So our average loan term is about 12 months. Most of our borrowers are borrowing money from us to buy a investment property. A lot of times they are doing what we call a value add. They are rehabbing the property and increasing the value. And then they're typically exiting the loan by either refinancing their loan if they're going to hold it as a rental loan or a rental property, or they're exiting our loan by selling the property for a profit. The lender, that's what we refer to as you, the private investor who typically funds the loan and receives interest income in return for lending the money out. Collateral, you hear this terminology thrown around a lot out there. This is the loan is commonly secured by a first lien position. Sometimes it's a second lien on real estate. That's not unheard of. If a loan is properly underwritten, there is some opportunity with second liens, but just so that we're transparent and clear, here at Central Lending, we only lend in a first lien position. And by having this lien and this collateral, the piece of real estate that's actually backing that particular loan, we're offering protection in case a borrower defaults. That is the risk in these types of transactions is at the end of the day, if a borrower doesn't fulfill their obligation to make their payments and pay you off, your recourse as the lender is to foreclose on the collateral. And then we talk about loan terms. This refers to, what are the interest rates? They're generally higher than a conventional loan. A lot of very qualified borrowers come to us, and I think on that note, in the past, a lot of private lenders have this bad reputation that we were the last resort out there, that these borrowers were not qualified. They couldn't go to a bank because they didn't qualify. That is not necessarily true. We have very sophisticated, very financially sound borrowers that come to us because they know that we can move very quickly versus a bank that, if any of you have gotten a mortgage anytime in the past, probably 1 to 2 years and maybe even longer ago than that, you know that it's a pretty painful process. So these borrowers are very sophisticated. We do quite a due diligence process on them to make sure that they're qualified, but they know that we can move quicker than a traditional bank. Loan terms are typically 6 to 36 months. Like I said, on average, our typical loan term is about 12 months. You're not going to see anything from us for more than 24 months. And then rates are typically 8 to 12%, depending upon the borrower, what their qualifications are, what their track record is. The conversation I had with this person yesterday was, high risk comes with higher returns. If you don't want a promissory note that is as risky, maybe the borrower is not as qualified, maybe the property's in a less than desirable area, then you're probably going to expect a higher rate of return versus the investor that wants a very qualified borrower with a proven track record with very strong credit in a very desirable area. Your rate is going to be a little bit lower. So these are risk adjusted returns. Just keep that in mind when you're looking at notes. Very rarely are you ever going to get the best borrower that's the most qualified for the highest rate of return. That's not really the way that this works. So let's talk a little bit about how you can actually invest in private lending, because this is something that probably in the last 5 to 10 years has changed. When I first got in the private lending space, really the only option, and I'm probably going to date myself, I've been in this over 20 years, was that you could just buy notes. Private lenders would get borrowers that were applying for loans. They would do their underwriting process. They would do their due diligence. And then the capital raising team would start finding a lender that was going to bring their money in to the closing transaction, and they were going to close that loan with those particular funds. And so that's what we would call direct loans to individual borrowers. You are one investor typically to one borrower, and you are funding the whole loan. You are on the mortgage, you are on the promissory note that is securing your investment, and you are just one investor. As you can imagine, years ago when we functioned that way, it was very chaotic, right? You've got a borrower on one end that's very urgent to close on a transaction. Most of the time your sophisticated borrowers are finding people to buy these properties from where time is of the essence, right? It's an emergency. They need to get it closed. They're getting a great deal on it because they can close quick. So they're going through this due diligence process and underwriting process. They're getting approved. And now the capital marketing team saying, well, hold on, I got to go coordinate with Jamie, and he's funding this deal with his IRA, and it's going to take us about a week. So it was, as you can imagine, a very clunky process. It was a lot of managing expectations, being very proactive, like, hey, we've got this deal coming. Let's get, a lender on this end of it coordinated so that we can get their funds in quick enough to help this borrower close on time. And about probably a little more than 10 years ago, people started opening up debt funds. And this was a way to raise money in your debt fund ahead of time, and this gave the ability for investors to not have to have as much capital available to fund that deal. They could go into a pool with other investors. We could hypothetically go and close the transaction for the borrower, get them taken care of, and then also sell the debt on the back end of it. But it was a little smoother process, right? We were able to take care of borrowers very quickly. We have the ability to allow investors to come in with less money than they normally would have had to with a note. And that's what is called investing in a private debt fund. So this is basically a bunch of investors' money that's pooled together in one fund. Operators like central lending are managing the fund and its activities, and we are able to create profit for the investors in the fund by deploying it through private debt. There's also crowdfunding platforms. Some of you may be familiar with this. Years ago, there was a crowdfunding platform called Peer Street, and you could actually go in and you could buy fractional interest in different notes. So you've got 50 grand, you could go in and hypothetically put 10 grand in 5 different notes. You could see which notes you're investing. They're not as common anymore, but they are out there. I would just, tell you to tread lightly with those. You don't have a lot of recourse when you're a fractional owner of a note. So do your due diligence on that. And then you can partner with private lending firms as well. So just a couple, 3 or 4 different ways that you can actually get involved with private lending. We're going to go into really specifics, what's the pros and cons of each. And like I said, you as the investor need to decide what your appetite is, how risk adverse you are, what you're willing to take on. So how investing in direct loans typically work. Typically a borrower comes to a lender. They're needing quick capital for a real estate opportunity. You as the private lender typically evaluate the deal and you fund the loan. The way that you get paid is the borrower pays monthly interest payments. Typically, that's not always the case, so it's important for you to do your due diligence on the loan documents. Sometimes it's quarterly interest payments. I've even seen private money loans where the borrower was not required to make any interest payments at all during the life of the loan, and then they pay all the interest owed off when they pay the loan off plus the principal balance. So all of this type of information is going to be in your promissory note. We'll talk a little bit more about that. But just understand that when you are lending your money out, you are basically getting paid because you are earning interest on your investment. At maturity, typically the borrower repays the original principal balance. That's what I was talking about. Most private money loans are interest only. So just know that you should look at that information in your promissory note that you're possibly buying. And that's a very different calculation than most people's mortgages. Most people's mortgages on their primary residence is what they call PITI, principal, interest, taxes, and insurance. So a borrower has X amount of dollars they have to make every month, and then it's divided up among those things. They pay principal, a little bit of principal. It's amortized over 30 years typically. They pay interest. They also pay a portion of their taxes and insurance. So private money is a little different most of the time. I don't want to say always. Every private lender is different, but the majority of the time they are interest-only payments. And then you have the option to reinvest in another loan or take your funds back when the borrower pays you off. So some people really like direct loans too, because if they've got investments in longer term investments, like maybe a syndication on an apartment complex or a self-storage unit, those are typically long-term tie-up periods, 3 to 5 years. A lot of people will diversify and sprinkle in some private money loans, direct private money loans, because they are shorter in term. But again, always refer back to your promissory note so that you fully understand what the terms of that note are. Let's talk a little bit about due diligence, because this has actually came up very recently with myself and some of our clients. We provide a very strong due diligence package, and we'll talk a little bit more about the things that you should be asking to see, whether you're buying a note from central lending or somebody else. It's all the same information you should be asking to see. or collecting if you are the original lender on the mortgage and the promissory note. What we do at Central Lending is we actually close the loans first. So we do a full underwrite. We feel comfortable enough about the deals that we close them on our fund, and then we sell those notes off. So they are pre-funded. That means you can't look at one of our deals and say, hey, I'll do this deal, but I don't want to give them 12 months. I only want to give them 6 months. And I'm not going to accept 10%. I want you to charge them 15. These are pre-funded deals. And I think the benefit to that is we underwrite all of these deals like we're going to keep them. So if we don't sell them, we're comfortable enough about the deals that we're going to keep them in our portfolio. And I think that says a lot for Central Lending. We're not just trying to coordinate a borrower that needs to borrow money and go find John Smith that's got an IRA and we partner them up. We get our origination fee and we're on our way and we have no skin in the transaction. So we're going to talk a little bit about, what you should be looking for when you are doing due diligence on a one-off note deal. Big, like hot topics for me: review the borrower's track record. It doesn't mean that we don't fund notes or you shouldn't buy a note from somebody that's never done a deal before. There's other things that you can look for, but that's kind of where I start when I start looking at these projects, is like, what's this person's experience? If you've got a guy that lives in California and he's buying a investment property in Illinois, the first thing I'm going to ask is, what's this guy's experience? How's he going to manage this project from California when he's investing in Chicago? And so if I could see, hey, this guy owns 10 different investment properties, rental properties in the Chicago market, that says a lot, right? Like, this person has experience. So it kind of goes to the second point. What is their experience? Do they have experience with similar projects or asset types or geographical locations? These are questions you should ask if they're not within that due diligence package. And to be honest, if you're asking these questions, and this is something I empower investors, know what your hard no is. If you're asking these questions and whoever's trying to sell you this note or convince you to lend them money is not answering these questions as well as providing you documentation to back up the answers, that would be a big red flag for me, and I would be a hard no and move on. What is their credit worthiness and their financial strength? Credit scores are very skewed. I have some people that are like, I only look at people with 750 credit, and I will tell you, I have looked at enough credit reports over my time, and especially if the borrower is a very seasoned borrower that has a lot of projects going on. I'm an active real estate investor. I use my Capital One card because I want to fly everywhere free. And some of you probably know, when you have high utilization, that sometimes can affect a credit score more than having bad credit. So I wouldn't get so hung up on what is their score. I would really look at what is the history of their credit. Do they have a poor credit score because they don't pay anybody and they have tons of late payments and repossessions, right? Or is their credit good, meaning they've paid everybody as agreed and never missed any payments, but maybe because they use these credit cards because they have multiple projects going on, could that be affecting it? But you should understand overall a snapshot of what their credit situation is and what their financial strength is. Because the other issue is, and it's on the bottom of this list, viability of their exit strategy. We have had borrowers come to us that have no experience. They're buying a property, they don't live in the area, they're going to rent it, and then they're going to refinance it into a 30-year, what we call a rental or a DSCR loan, which is really just a loan for somebody that's holding a rental property. And they've got 500 credit. Well, I'm here to tell you, they're not going to refinance in 6 months with that. They need to have experience. They need to have a signed lease. They need to have decent credit. So understanding what their overall picture of their finances and credit is really important. You can look up reputation and references. We live in the world today where you can Google anybody. And, if they're a contractor and they're saying that they're active, we do pull background reports as well as credit reports that you have access to actually review. We do protect sensitive information. So just understand, if you are a borrower or broker, we're not sending that information out to anybody. But you can Google somebody. If he says he's an active contractor in Texas, Google his name, see if there's any complaints. You can find a lot of information on the internet. And then lastly, the big one is, what is their skin in the game? Do they have money into the transaction? If it's a refinance transaction, I would always want to know how they obtained the property. Did Aunt Sally just leave it to them and they inherited it and now they're trying to suck a bunch of cash out of it? Or is it a property they bought 6 months ago that they paid cash for? They have a HUD or a settlement agreement to actually show evidence that they paid for it. To me, that's big skin in the game. I will tell you, over the years, I've seen assets not perform, and the common theme typically for non-performing assets is the borrowers don't have any skin in the game and they don't have anything to lose. So that is a question that I look pretty heavily at, is like, at the end of the day, if they have some challenges, what keeps them there actually making their payments? You also need to obviously evaluate the real estate asset. Understand what kind of property is it? Is it residential? Is it multifamily? Is it mixed use? Understand the location and the market trends that the property is located in. Because I tell people, at the end of the day, if the borrower doesn't perform, you may own that property and you need to be comfortable. And I have a lot of lenders that are like, I hope they never pay me. That's in a great market. It gets good rents. If I were to ever have to take it back, I'd just keep it in my rental portfolio. Or, hey, I've got a ton of equity. I feel really comfortable. This is in my own backyard. Love it. Obviously, I hope that they pay and pay me off. But at the end of the day, if they don't, I'm completely comfortable taking it back. On the flip side of that, I've had people say, oh my God, I'm going to not sleep at night because I don't want this property back. That's not the right deal for you. You want to know what the value is. So you can obtain and do your research multiple ways. Obviously, an appraisal will give you a very good idea of what the value of the property is. We also use hybrid valuations. They're called richer value reports. I personally think they're even better than appraisals. You could get a BPO from an agent. You can get online, pull it up on Zillow, look at the map, do the lot lines. You can see what other houses have been selling for around there. Don't just take somebody's word for it. You need to feel comfortable with what you think the value is. And then lastly, what is the status of the occupancy? This is important. If it is occupied, are there tenants in it? Are they paying? Do they have a signed lease agreement? If there are tenants in it, you should be getting a signed lease agreement. So that in the event that you ever had to take it back, you understand what the agreement is with. I have heard horror stories from lenders that bought a note. There was tenants in it, so they thought. They ended up foreclosing, and come to find out the tenants have been squatting, but because they have a signed lease agreement, they can stay in it forever not paying rent, and it's extremely expensive to kick them out. So just understand what the status is of the property, who's living in it, are they actually obligated to pay? Are they currently paying? I personally just bought a piece of real estate in my local market. I was told there were tenants in it. It was a very quick close because it was from a wholesaler. Come to find out, the tenants were squatting. And shockingly, they got out in 30 days and we didn't have to fight them, but they could have drug it out a lot longer. So ask the questions. And, like I said, whoever you're buying that note from should be able to answer those questions. Okay, so this is talking really specifically about the terms of a loan. And so this is really important, and it probably sounds silly, like, of course people should ask this. You would be shocked how many people do not ask these questions, do not really understand what they just bought. So number one, what's the loan to value? Loan to value is what is the amount of the loan that you are lending to the borrower in comparison to the value of the property? Typically, kind of common LTV thresholds is under 70%. It does not mean that's always the case. There's always an exception to the rule. Maybe you have a borrower that you've lent money to 20 times and he's paid you off every time, never missed a payment. You might give him a little bit higher loan to value. And so I think you have to look at that, on a case-by-case situation, but kind of industry standards is about 70% loan to value. Typically, these deals have a minimum of 30% equity in them. So an example of that is a property's worth $100,000. You provide them with a loan of $50,000, you would have a 50% loan to value. You have potentially 50% equity in that deal. And that's important to know because you need to think about worst case scenarios, right? At the end of the day, if this person doesn't pay, I'm going to have to foreclose. So you need to take in consideration foreclosure costs that you may have to front. I've seen them anywhere from $5,000 to $10,000 and on up from there, So you've got that to take into consideration. Typically, when a borrower is not making their payments and is defaulted on their loan, you may have to actually remodel, rehab the house, kick out tenants when you get it back. A lot of times they aren't paying their hazard insurance, so you're going to have to make sure that the property stays insured, and you're going to have to probably get what's called a force-placed insurance policy. That's an additional cost. And then you may have to deal with property taxes that are owed. So it's important to know, for example, on that scenario I gave you, there's $50,000 in equity, right? Hypothetically. So you put $5,000 in for an attorney to foreclose. Maybe it's a couple $1,000s for hazard insurance. Now you're at $7,000. Maybe it's $2,000 in property taxes. Now you're at $9,000. Let's say, just for round numbers, you spend $10,000. Now you got $40,000 in equity left. And so you need to look at these like, how am I going to get out of this hole? How can I make money? Some people look at this as an opportunity. We are not a loan-to-own company, just so we're clear. But the foreclosure is not as big and scary as everybody thinks. And sometimes there's some opportunity in it. But you just need to understand what you're getting into. So understanding what the loan to value is, what the property's worth versus what you're lending is very important. Understanding the terms of the loan. What is the interest rate? You'd be shocked. People are like, this guy promised to pay me 10 and I bought an existing note, but they actually were charging the borrower 15% and passing through 10. That's totally fine. It just needs to be disclosed up front. What is the term? So how long is the loan? Is it 12 months? Is it 24 months? Is it a 5-year loan? Like, you need to understand how you're going to get your money back and when you're getting your money back, right? These are just not open-ended loans. So understanding what the loan term is, and also understanding what happens if they don't pay it off at the end of the term. I actually just had a client email me, I think it was yesterday or the day before, and he said, okay, so at the end of 12 months, I just get my money back. Well, in a perfect situation, and 99% of the times that happens, but there's also that 1 to 5% chance that that borrower may get to the end of the term of their loan and say, hey, I can't pay this off. I didn't get it refinanced, or I thought I was going to sell the property. It's still on the market. It's not sold. What are my options? There is what they call loan extensions. And to be honest, a lot of investors love to extend loans because they get a little bit of extra interest. They'll charge, anywhere from 1 to 3% on the loan amount to extend the loan. And if they're a good paying borrower, they're more than likely to extend it and allow the borrower to just keep making their payments, pay their extension fee. But just know, it just doesn't magically happen at the end of the term of your loan that they pay off. And they also, on the flip side of that, can pay you off early. We do not charge prepayment penalties. Some lenders do that. We believe really strongly in not doing that because we don't want to penalize our borrowers for exiting our loans early and accomplishing their goals. We hope they come back and borrow from us over and over. So we don't charge prepayment penalties. What that means to you as a lender, you might buy a note from us and I might call you in 60 days and say, well, your guy paid off. Good news is we've got some other opportunities for you. I'm happy to show you those, but you are going to get your money back. That's not a terrible thing. I know it is sometimes a headache for a lender because now you have to go find a new home for it. You may have your capital undeployed for a period of time, but I would much rather have a borrower pay off early than not be able to pay you off at the end of the term of your loan. And then analyzing their exit strategy, I kind of touched on this earlier, and it's really important. Like, is their exit strategy even viable? I've seen deals where a borrower has never rehabbed or done a ground up construction and they think they're going to get in and out of there in 3 to 6 months. Maybe if it's a light rehab and they're really active in their market and they get it on the market quick with an agent and they understand how to stage it and market the deal. But just understanding, really, is this a viable exit strategy? Do I really believe that they're going to be able to exit and return my capital to me in the time frame that they're asking for. So we do look really closely at that, and you're going to get that information from us at Central Lending if you're looking to buy a note. But if you're out there trying to do this yourself, there is nothing wrong with that. If you're out there trying to source deals, maybe you're involved in like some real estate investment clubs. I've got some note buyers that have, 2 or 3, sometimes up to 5 rehabbers in their local market, and they just turn their capital with these guys. You still should be asking these questions. These are due diligence items that are not just done when you're buying an existing loan or note. It's also done when you're trying to do it yourself. So it's okay. You should be asking these questions. And if you're not, I would probably go back to kind of your checklist and add some of these things on it. And no questions yet. Let's see. Nope. Sorry, I just don't want to ignore any of you. If you guys have any questions or comments, please feel free to put those in the chat section. Okay, the other thing you guys should be doing is reviewing legal and supporting documents. So this is going to be a little bit different if you're buying an existing loan versus you're trying to create your own promissory note and deed of trust. If you're trying to do this yourself and you're going to secure your investment with a promissory note or a deed of trust or mortgage, I would really encourage you to get with a title company or an attorney to draw up those documents. We use legal to draw up our docs. Every state is different as far as the verbiage. So you want to make sure you're doing it right so that in the event you ever have to foreclose, there's no hiccups with that if the paperwork's not done properly. If you're buying an existing note, like what we sell at Central Lending, this is information that should be in your due diligence package. So you should be able to see, the promissory note. This is where you're going to see, how much the loan is for, what the interest rate of the loan is, what the provisions are if the borrower doesn't make their payments. Do they get charged a late fee? When is their late fee incurred? Is there a grace period? When the loan matures, what happens? If they don't pay me off, can I charge a maturity fee? Are they technically in default? These are all of the things that you need to understand so that you have a very good grasp of what your recourse is in the event that they don't keep up their promise on the promissory note. The deed of trust or the mortgage, it's one or the other, it's not both, is recorded at the county level, and this is the legal document that is recorded to put your lien of record. So Heather Dreves lent John Smith $100,000 in a first lien position on the property at Grits Lane. That is recorded at the county level. That is the actual legal document you can actually foreclose on. The promissory note is just their promise to repay you. You want to look at title reports and insurance. This is a big one. I've had lenders that lent money to people. They did not pull a title report, or they bought a promissory note and never looked at a current title report, and then realized after the fact that they were not in a first lien position. So title reports, title insurance, this is going to tell you what the chain of title is. Is there other liens on the property? Am I truly in a first lien position? That's what the insurance is going to insure you for. Yes, you're in a first lien position. Title reports can identify all kinds of crazy things. It's going to identify who the actual owner of the property is. In my experience, I've seen people apply for loans on real estate that they didn't even own. We pulled a title report and realized they weren't even the legal owner of the property. You're going to be able to see if a property is in a bankruptcy proceeding, if it's in foreclosure, if an HOA has liens against it for unpaid HOA dues. Property taxes will be on there. You want to make sure that property taxes are being paid current so that the county doesn't foreclose on those. So looking at a current title report, making sure you're going to get title insurance is very important. If you're buying an existing note, you want to make sure that the title report and insurance is transferable. So ours are, so make sure that that is the case. And then you also want to review that there is hazard and liability insurance that is enough to cover your loan in the event that the property has a loss. It blows down, it catches on fire. And then you also, kind of on a side note, need to make sure that you're tracking that. We do track it. We get notified as soon as a borrower cancels their hazard insurance or they don't pay it. And we have the ability to put in place what's called force-placed insurance policy to make sure that that property is always covered. So again, legal documents, promissory note, deed of trust, mortgage. Make sure you're reviewing a title report and making sure that you have valid title insurance. And I would only accept that from the big names out there in the title world. I've seen mom and pop title shops that we've received, not central lending per se, but companies have received what they thought was title insurance, and 6 months down the road, the title company's closed up and nobody's there to actually make a title claim to. And then again, hazard and liability insurance are a big one. So things to consider when you're thinking about purchasing a direct note. And these are risks, right? And I like to point it all out. There's pros to it, there's cons to it, there's risks to everything you do. And I think if you guys can go in with your eyes wide open with these direct notes and know what the risks are, know what the things are that you should be asking for from a due diligence perspective to mitigate risk, I think you can be really successful at this. Risk number one is a borrower defaulting. Hey, this guy might not make his payments. You need to be prepared for that. And you need to, more than anything, be prepared to make decisions. Like we provide a very concierge service at Central Lending for our note buyers, and they will attest to it. Like, we don't ever want you to have to call a borrower. Let us do our work. We will do the collections. We will make sure that they're getting their rehab project done. We will make sure that they're paying their insurance. We will make sure that their monthly payments are being made. And if any of that doesn't happen, we're going to be communicating that with you. And we will orchestrate what you want us to do, but you have to be able to make those decisions. I've had lenders that are like, this guy hasn't paid me for 6 months, but I feel really bad putting him in foreclosure. It's like, oh my gosh, this is your money invested in this. I think it's not even the money that it might cost you, or it's more the decision to actually move forward. And I will say, the quicker you can make a decision, like, yes, send them a notice of default, they typically rectify themselves. Typically a borrower will get us a notice of default and realize, oh wow, they're not really kidding around, I need to make my payments. It typically solves the problem. But the ones that you let limp along for months and months typically continue to be a problem account until the day they pay off or you foreclose. It just is a thing. So be prepared to make those decisions. Consider market conditions that might affect your collateral value. Are there markets that are soft, that the market is not moving and selling as quickly as it was 6-12 months ago? It's important to know those things. Illiquidity, know that your funds are typically tied up for the long term. It's not like you magically at 6 months get to decide you don't want to be in the deal anymore. So be prepared. If it is a 6 to 12 month loan, just know it might not pay off magically at the 6 or 12 months. So you're not as liquid as you might think you are. Understand again what happens in default. That was what I was talking about with the terms of your promissory note. Understand what your recourse is in the event that they don't perform on their note. Is there a personal guarantee? We only lend to entities, and then we make those entity members actually personally guarantee the loan. It prevents borrowers from hiding behind an LLC or something like that. But understand what that means. Personal guarantees, and I'm not going to get too far in the weeds. We could probably do a whole webinar on them. They sound great in theory, they're big and scary, but they take some time to chase. And really what a personal guarantee means to you as a direct note holder is if you lend money on a note, you foreclose, and for some reason you experience a loss, you can go after that person for the deficiency, the difference. Maybe you lent them 100 grand and you were only returned to 80,000. You hypothetically could go after them for that $20,000, and you could attach a deficiency judgment against bank accounts, other real estate they owned, all types of things. You can garnish wages. They're difficult to chase, but they do eventually pay most of the time. But just know what is your recourse with that? Understand, is the asset income producing or speculative? We talked a little bit about that. And then also understand your legal recourse as a lender. If you have any questions, I would suggest getting with an attorney in that local market, because every state has different foreclosure laws, and just understand what your recourse is if you're not familiar with that. Okay, so we're going to switch it up a minute. We're going to talk about debt funds. So we've talked about one-off notes, your one investor to one note. We're going to talk about what it really means to invest in a debt fund. So let's talk about the benefits first. Typically, there's pretty predictable passive income. There is typically regular interest distributions. Sometimes those are monthly, sometimes those are quarterly. That should all be in your offering document. You should understand that before ever investing in a fund. How do you get paid? When do you get paid? Do you have the ability to reinvest your earnings, or do you have to take your earnings as a payout? Common preferred returns are 8 to 10%. I will tell you that preferred, just so that we're all clear, is not a guarantee. It just means that when profit is paid out of a fund, the preferred is paid first, meaning the investors in the fund get paid first, and there's typically a profit split after that. That's what motivates fund managers and operators to get their funds performing well above a preferred rate of return. But preferred means you get paid first, and it's anywhere from 8 to 10%. We have one fund that has a preferred rate of 7, and we have one fund that has a preferred rate of 9. There's lower volatility than equities. Returns are tied to loan performance, not market swings, providing our borrowers make their payments and we don't have huge deficiency or default issues. Our fund is profitable. They're typically backed by real estate or other hard assets. Ours in particular are backed by real estate, but I've heard of other debt funds that are car loans, paycheck advance loans, things like that. Typically, your debt funds are going to provide you with diversification. You have exposure to a broad portfolio of loans. Remember, I talked about taking your 50 grand, buying one loan. Obviously, if that one loan doesn't perform, your cash flow is affected, versus taking your $50,000, putting it in a debt fund, and there's 300 assets in that fund. I'm just using that as an example of numbers, but there's hundreds of loans in our debt fund, and you don't see the effect if one guy doesn't make a payment. It does reduce your concentration risk compared to direct lending. There's professional management. We have a massive team. We have an underwriting team. We have a processing team. We have a servicing team. We have a team that manages rehab draws. This is what you get investing in a fund with an operator like us, versus you trying to do that all yourself. So fund managers typically underwrite, service the loans. They have access to institutional quality deal flow and oversight. That is one thing I hear from investors that are trying to do one-off deals themselves. They have a hard time keeping deal flow up. We're somebody like us, we get hundreds of deals submitted to us a week, and we can cherry pick and we can pick the best ones, versus the guy that only gets one or two a month, and he's desperate to get his money deployed. I think you have much better deal flow when you're going into a debt fund with a professional fund manager. You also have the ability to reinvest your earnings. That's a big one. Interest payments can be reinvested, and this creates a compounding growth effect on your investment dollars. It's huge. Run some numbers on 5 and 10-year compounding earnings, especially on a monthly basis. It's really powerful. You folks on here, and I recognize some names. I know some of you guys have self-directed IRAs, and that is a great tax strategy to invest your dollars. The challenge with self-directed IRAs is custodians have a lot of fees. So when you have dollars going back and forth from your custodian and your investment, you're getting charged a lot of dollars. You also a lot of times have dollars sitting in your account because now you're waiting to have enough to invest it in something else. When you're in a debt fund, especially similar to ours, you can just reinvest your earnings. We let your custodian know at the end of the year what your fair market valuation of your account is, and you don't have this undeployed capital. I also talked about that when you guys get paid off with direct loans. I will tell you, my husband and I both have IRAs. We don't like notes right now because they're too, we have to find a new home for it, right? So every time we get paid off, we're having to find another deal. We would much prefer a fund, especially a fund that we can just reinvest our earnings and we don't have those dollars sitting in there. So these are things that you guys need to think about when you're looking at these opportunities, as well as like, I'm not trying to say debt funds are better than one-off notes and vice versa. I think it depends on you as the investor, what your appetite is, what kind of dollars you're trying to deploy. I have some clients that do both, and it's all dictated by what kind of dollars that they're trying to put out there. A lot of them like to do direct deals when it's personal funds versus their IRA dollars they'll put into a fund environment. So potential risks with a fund. Illiquidity is always a risk as well. Funds often have lockup periods or redemption restrictions. It's not like your traditional investments and you can sell off stocks immediately when you need some cash. They typically all have a lockup period. We have a 12-month lockup period. We also actually have a 4-month option as well. Most funds don't have that. But we do offer a very short-term option to just park some capital. I had some clients 4 months ago do this. They sold their house. They had a big lump sum of money, but they're buying another house. They put it in our fund for 4 months and they were getting 8% on their money. But just know, funds typically have a tie-up or lockup period, so just understand what that is. Borrower default, risk of missed payments or foreclosures mitigated by underwriting and collateral. These are all risks as well. Market and economic conditions. These can affect, real estate values. This can affect a borrower paying us off, so obviously looking at the borrower's strength is really important to understand, if they can actually weather the storm. Interest rate changes can affect fund performance. We haven't seen that recently, but know that that is something that can affect a fund. Manager risk, quality of underwriting, servicing, operations vary by manager. Lack of transparency can increase exposure as well. I talk a lot about this with clients is, it's great to understand what a fund offers and what your rates of return could be and all this good stuff. But I think more than anything, you need to look under the hood and you need to understand who the manager is that's managing the fund. You are essentially relying on that manager's ability to manage that fund. So finding an operator or a manager that has a track record and is willing to share that track record with you, I think is really important, because more than the fund that you're investing in, you're investing in that manager and their team. So it's really important for you guys to understand that. I've heard horror stories of people that were talking with other fund managers and they were not willing to share a lot of information. They weren't transparent. They didn't report regularly. That would be a big red flag for me. And it's okay for you guys to ask for those reports. Hey, let me see your track record from the last 12 months, or even better yet, from the time you started managing fund. We have track record information back to 2016. You should have access to that if you are even considering investing with an operator. Other risk is regulatory and legal risk. SEC compliance, fund structures must be sound. Failure to meet exemptions or reporting can trigger scrutiny. So make sure that the fund is in good standing. We only allow accredited investors into our funds. Technically, they are exempt. There is still filing you have to do. So make sure that the fund and the operator is in good standing with all those things. This is a small site. I hope you guys can see this because it kind of looks blurry to me. These are, and I'm happy to share this presentation with you guys, but these are just this is a side-by-side comparison on direct loans to borrowers versus private debt funds. So level of control, direct loans, you choose each borrower and loan. Private debt, fund manager controls loan decisions. Diversification, in a direct loan situation, you're typically concentrated in a few deals. Exposure to many loans in borrowers is a benefit. In a private debt fund, you are better diversified. With direct loans to borrowers, due diligence is required. You must underwrite and evaluate each deal. In a private debt fund environment, the fund performs underwriting and due diligence. In direct loans to borrowers, the time commitment, active involvement is required. You are not a passive investor doing direct loans. This is the conversation I had with my client yesterday. You are an active investor. There's a lot that you have to do to make decisions on which which deal you're going to fund. In a private debt, you are very passive. Once you've done your due diligence on the fund manager and the actual fund offering, it's very passive. Really what you need to know is, hey, how often are they reporting? What kind of information am I going to get? Because you do need to keep checks and balances on them. With direct loans to borrowers, cash flow consistency, it all depends on the borrower's payment schedule and whether they make their payments. Private debt funds often pay regular distribution with options to reinvest earnings. Risk exposure with direct loans to borrowers, risk is not spread across multiple loans. In a private debt fund, risk is spread across the portfolio. I would say minimum investment with direct loans to borrowers, this is about the same, to be honest. I mean, I don't know that I would look at funding a loan less than $50,000 if I was doing a direct deal. Otherwise, you're probably looking at lending in a very distressed area. Not always, but typically. Private debt funds, I've seen some funds that will accept as little as $25,000. So it might be a little bit less to get involved with a fund. Direct loans to borrowers, access to deal flow depend on your personal network and different platforms. Private debt funds has access to curated and funded deals. Administrative burden, you must manage the loans, servicing and compliance, typically with direct loans. Unless you're buying them from us, we will manage that for you, but most of the time, lenders that are out there buying other notes are doing it themselves. In a private debt environment, all administration is handled by the fund manager. You do have limited ability to exit before maturity with a note. There are some platforms out there where you can actually sell your note, but you're probably going to have to sell it at a discount and be willing to take a loss on the asset if you really had a crunch for money. Private debts typically allow quarterly or annual redemptions after your tie-up period is met. And then lastly, direct loans to borrowers do require you to be responsible for underwriting. And in a private debt environment, this underwriting responsibility is performed by the fund managers themselves. So, like I said, I'm not here to tell you one is better than the other. I think it really just depends on the investor, what you're trying to accomplish, what kind of dollars you're deploying, and how active you really want to be. I will tell you, direct loans require you to be more active versus investing in a private debt. So benefits to investing in a private debt, and that white lettering just did not show up very well. It has steady, predictable cash flow. Payments are typically made to you either on a monthly or quarterly basis. So if you are truly an investor that is trying to replace income, have your money work for you, live off of that, debt funds are a great option for that because you get that consistent cash flow. They're also, debt funds are backed by real estate assets. Typically understand what the assets are that they're lending against. But if you are in a real estate fund, typically the asset is a lien against a piece of real estate. Also, there are shorter time commitments than notes, providing that the tie-up period is met and you understand what the redemption period looks like, whether that happens on a quarterly, monthly basis. They're pretty liquid after you've hit that actual tie-up period. Lower market volatility, and returns are tied to loan performance, not the stock market or economic cycles. So lots of benefits. Again, I think that, and we're going to kind of wrap things up. I don't see a ton of questions, but please, oh, there's a couple in here. Good. They're both great options. I mean, they really are the same asset class. They are notes. You're investing in a debt fund. It's a fund full of a bunch of debt, and you're buying a direct loan. You're buying a piece of debt. It's just that, do you want to go into a fund environment with a bunch of other investors, and do you understand who's managing that fund? Do they have a good track record? All those questions that we talked about versus doing your own due diligence on debt. There are some easy ways to buy debt, like what we do. We pre-fund the deal, we give you the whole due diligence package. Or are you out there trying to find your own deals in your local market and you're at REI meetups and things like that? That's probably a little more active than just buying a piece of debt from central lending. So just things to think about. I do have my contact information here up on the screen. I want to encourage you guys all to visit our websites as well. That number is my direct number. You're welcome to reach out to me. I encourage you if you guys want to talk more, have more questions. John's got a couple questions in here, so I'm going to answer those. And if any of you folks that are still on here have some additional questions, happy to address those as well. John says, I understand the need to have a lockup period. I understand yield drag, but the debt fund seems probability long. You might want to, John, if you're still on, maybe just kind of clarify. Actually, here, let's see. I understand the need to have a lockup period. I understand yield drag, but the partial payoff in the debt fund seems long. I'm not quite sure what you're talking about, John. Maybe you could clarify that question. You have another question, and I'm going to address that one. Maybe you can put some clarifying information on your first question. John also said, are your individual notes wrap notes? What is the spread? What determines the spread other than the volatility, note size, length, and the note? No, these are not wrap notes. We originate new paper. We do not buy existing notes. And so these are newly originated. We originate these loans, and the next week they're on the market to sell. We sell a lot of notes, John, and everybody else, to private investors, individuals. We also have quite a few relationships with capital markets, Wall Street Capital, that buys a big volume of our paper, which that should tell you the kind of quality of paper that we lend to. The spread is typically dictated by the note. Every note is different, but I would tell you we try to retain anywhere from a 1% to 2% spread on our notes. And what he means by spread is if we charge a borrower 11% on a note, we're going to market that note to sell it at 9%. If we charge that borrower 12%, we're probably going to market it as a pass-through rate to the note buyer at 10%. So we do still have some skin in the game. We really want that. We really want that note to perform, because that's how our funds become profitable, as well as we're retaining that interest strip, or that what John referred to as spread. Note size, I would say our typical average note size is, 175, and then length of our notes is about 12 months. We don't write much longer than that. John says you have 2 years to get your principal back in the PPM. What he's referring to is after your tie-up period of 2 years in our first fund, then you can start to redeem your investment in the fund. We actually, on average, return capital once someone puts in for the redemption. I think the longest it's taken us is 2 weeks. So it's been very quick. But understand that there is language within our funds to protect the fund. We need to do what's in the best interest of the fund, and we have to have language in our funds in the event that we have what we call a run on the fund and everybody wants their money out. I can't imagine that ever happening, but understand that we have legal that has drawn this paperwork up, and we have to systematically exit people or redeem people out of the fund on a first come first served basis. Hopefully that answers your questions, John, but good questions. Let's see. Oh, it looks like we got all his. Any other questions? I see a lot of new people on here, so that's super exciting. Couple things on the one-off notes. If you do have interest in buying any of our notes, shoot me an email at heather@centrallending.com. We will put you on what we call our email blast, and we send those deals out 2 to 3 times a week. As we get new deals in, we'll send some deals out there. These are just kind of little snapshots of what the deal's about. What's the loan amount, where the property's at, what we believe the value was, what the borrower's exit strategy is, and a little bit of highlights about the borrower. And if you have interest in any of those deals, you can let us know, and we'll provide you with what we call the due diligence package. This is the package that is all the information that we use to underwrite the deal. And, like I said, when we were going through this presentation, those are the things that you should be asking for. And so we'll provide you with that due diligence package. We do have to have you sign a non-disclosure form, but that's just kind of housekeeping items. If you decide you want to move forward with funding the deal, we draw up all the legal paperwork, transferring the promissory note to you, transferring the mortgage or deed of trust to you. We actually take care of recording it for you. We do not charge anything for any of that. And then we set it up with a third-party servicing company that collects the payments, sends the payments to you. We do all the collection calls. You don't ever have to talk to a borrower, but we do utilize a third party to keep track of payments, what that borrower's paid and what they've paid you. They do charge a $65 setup fee as well as a $20 a month servicing, but Central Lending does not. This is not a profit center for us to sell you notes. The benefit to us is we can originate more through our funds, which makes more money for our fund members. If you do want to inquire or explore going into the fund, it does require you to be an accredited investor. Just understand that. That means you have to either qualify through your income or your assets. I'm happy to talk with anybody offline about what that looks like. We will even get you qualified if you believe you're a qualified investor and pay for that. And then you can get involved with our funds with as little as $50,000. So happy to talk more offline about this. There's lots of options. I think they're both great options. It really just depends on how risk adverse you are, what kind of dollars you're investing, and really at the end of the day, how passive you really want to be. But happy to talk about that. So you can text me, you can call me on that phone number. That is my direct number. You can shoot me an email. Would love to talk with you more about that. Hopefully you guys all found this valuable. We're going to have another webinar next week, or not next week, next month. If you have any thoughts on topics you'd like us to talk about, I'm totally open for advice on that. We haven't made a decision yet on the topic for our webinar in July. So feel free to shoot me some ideas. I'd love to hear your guys' thoughts on that. And again, I do appreciate you guys. I know that for a lot of you folks, this is later in the evening and you have families, so it means a lot that you guys have taken time out of your busy schedules to be with us. And we'd love to talk to you more if you're not already involved with us. If you are involved with us, we appreciate your partnership either in our funds or in our notes. So you guys have a good evening and look forward to seeing you all on the webinar next month.